In this problem, I'll go through Work Together 12-4, and it's page 360 of your Century 21 Accounting Textbook Advanced, edition 11 by Gilbertson and Lehman. So credit to them for this text and this problem. Okay, so we are journalizing bond investment transactions. So we're going to pretend we are FTR Investments, and we specialize in investing retirement funds for teachers. So on January 1st, we have the following bond investments already in our portfolio. PlanMat Corporation, we've got Opel Industries, and so we are going to know that we have these journalized transactions completed during the current year. Okay, so our first one, we already have these two, and we're going to purchase another one. We're going to purchase 40 of Mason Electronic Corporation's $5,000 face value bonds, $5,158.16 each, totaling $206,326.40. Check number 624. So we're purchasing, it's got to go in our cash payments journal, right? And this is June 30th. It's going to be an investment securities. And it said it was check number 624. All right. And it told us we paid $206,326.40. So that's really the key number here as far as our transaction goes. So a debit to investment securities, a credit to cash. We're done with this one. Next entry, July 1st. Received the semi-annual interest payment on the PlanMat Corporation bonds, receipt number 642. All right, so we're up here with the PlanMat bonds, and we're receiving some interest. So it will be in our cash receipts journal now. On July 1st, receiving interest would mean interest revenue. Okay. And how much are we going to receive? Well, we're going to have to calculate that. So our interest revenue is carrying value of the bonds times your effective interest rate times the time as a fraction of a year. So carrying value of the bonds is $74,588.27 times the effective interest rate. It says 5.2%, 0.052, times the time is a portion of a year. This is semi-annual, so 0.5. So $1,939.30, and that is your interest revenue credit. All right, so the cash debit is not the same amount. And to find the cash debit for your interest payment, it's going to be the face value. So this time we'll start with the $75,000, and we'll take that times our stated interest rate. This was just the 5%, right? That was what it stated to be. So 0.05 times the portion of year, 0.5, or half a year, and that gets you $1,875 on your interest payment. All right. So then we're going to have to debit investment securities, because right now our cash debit is lower than our interest revenue credit, right? And that's all having to do with the yield of 5.2% compared to the 5% that it was stated at. So the difference there is going to go to investment securities. And we'll just subtract them to get to our $64.30. All right, so the next one. Received semi-annual interest payments on the Opel Industry bonds. Receipt number 643. So we've got interest revenue again. And we'll have another entry just like the last one. Because the interest rates were not the same, there will be investment securities portion to this as well. And this, oh, did I miss the document number? I sure did. This last one was receipt 642. And this one says it is receipt 643. One right after the other. All right, so let's figure out first our interest revenue for this one. The carrying value. So it says it's got 120,422.07 times our effective interest rate, and that says it was 5.9% or 0.059 times a half a year, and that is $3,552.45. Okay, cash debit. We will take our face value of the bonds, which was $120,000. We'll take that times the stated interest rate of 6% times a half a year. Semi-annual payment, $3,600. So this time our debits are greater than our credits. So the investment securities is going to have that credit to make up the difference of $47.55. And you can see why, right? On the first one, we had 5.2% yield compared to the 5% stated. And this time, the yield is less than the stated. So it's the opposite effect. Okay, that makes sense. So we'll move on to the third one. We are going to sell these Oakland Industry bonds. And we're selling them for $122,754. All right. So we know we have investment securities. That's where these Oakland bonds are at. And we know the amount that we received so far. So this was receipt 644. And just after we got our interest payment, we are going to sell them. So we've got our interest, now we're going to get rid of them. Okay, and the amount is $122,754. That's the amount of cash we got from selling them. But that's not necessarily the amount they're on our books for. So we're going to have to figure out whether we had a gain or we had a loss. So what's the calculation? Well, we need to know the book amount first. So we know we purchased them originally at $120,422.07. So we'll start with that. And in our previous entry, we reduced our investment securities by $47.55 as a part of our normal interest and getting rid of the premium or discount amounts, right? So we've got to subtract away the $47.55 credit, which leads us to what we have them on our books now as, $120,374.52. So if that's what they're on our books for, but we sold them for $122, then we have a gain. A gain on the sale of investments. And that's just going to be for the difference between the two. Right? We'll just subtract. So the gain is $2,379.48. That's a pretty nice little gain that we made in a half a year from buying these bonds. So that was kind of a lot. There's, lots of stuff going on here, from the purchase of investments to receiving the interest and then selling these bonds after we receive that first interest payment. But I think you can do it. And the On Your Own is in another workbook, so good luck.